So give us your sense about if we have rates that go up, and if they stay there for a long time, what does it do to the world of credit? And which is more important, how high it is or how long it is?
So that's a good question. I think what's more important is how long it is in terms of the impact of credit. So a couple of things. One is, I think the world's changed its narrative instead of whether or not rates go up, it's how long rates stay up. And for corporate credit balance sheets, I think there's two things that are happening. The first is that there's a lot of investment grade and high yield and loans that will reprice over the course of time into this higher rate environment. So that's one thing. And two is companies are living in this higher rate environment, which means they're getting cash flow squeezed a little bit as they're repricing their debt. And you'll see that across investment grade. I think you'll see it across high yield. Now, the loan market's floating rate, so they're participating in the rate move. They've participated in the last year and are continuing to participate. But really, it's high yield and investment grade and fixed rate assets that are starting to reprice, and you're going to start to see the impact.
So interest rates were really low for a long time. To what extent did the corporations go out and say, let's lock in a lot of long-term debt at really low rates, and so they're protected against this for some period of time to come?
A lot of them did it, and they are protected. And there is you'll hear the words maturity wall, but you're certainly starting to see that cliff come into play. Not necessarily in 2024, but in 25 and 26. And mind you that most companies don't wait until the maturity to refinance their debt. So oftentimes you're seeing companies refinance 12 months inside, 18 months inside. So the numbers are pretty big in that the estimates are anywhere from 30 to 40% of investment grade and high yield repricing into this higher rate environment over the next, call it, 18 months plus or minus.
So what are the most active parts of your business right now in credit? Where's the most activity?
There's a lot of activity in the private credit world. I think you've probably read a lot about that also. But that's a very, very active world right now. The private credit, private credit's been around for a long time. And private credit has taken share from the banks, and they're taking share from the syndicated markets. So there's a ton of activity there. Up and down the capital structure. And I would say there's more interest in activity across corporate credit. Certainly when you look at equities versus credit, there's been a veer towards credit because, number one, the base rate environment is so high, it's likely to stay high. And number two, there's spread across the market. Now, spread's not terribly attractive in and of itself, but yields are. So investment grade, high yield, levered loans, there's, the high yield market's trading at, 420, 430 over, and the loan market just around 550 over. So you're looking at 8 to 10% yields in high yield and loans. And in the private world, it's a couple hundred basis points on top of that.
How big is the private credit breadbasket? Because I hear conflicting things, as you say. Not a day goes by that we don't have some big story about private credit, a lot more money on private credit. On the other hand, I've seen some comparisons say, look, as a percentage of all debt, it's actually not that big. It's relatively modest.
Yeah. So I've read all these same numbers as you have, and in the argument for it being not so big, people rightly compare it to bank balance sheets. $100 trillion, $98 trillion of bank balance sheets, and people compare it then to, and in the spirit of it being larger, people compare it to high yield and to the loan market. High yield and loan market are roughly $1.3 to $1.5 trillion in size. The private credit market's about $1.5 trillion in size. But there's one really important part of that, which is that number that is quoted is actually inclusive of dry powder. So I think that's a really important distinction as well. And so that's a big market, and we love that market. We think it's a terribly attractive market, especially right now. But it's about 900 to $1 trillion of invested dollars, not the 1.5 trillion that you see of invested dollars.
We've heard a lot, particularly when the interest rates were so low, about covenant light, or even very, very light covenants. Is private credit different? I mean, is it an advantage to private credit because they sharpen their pencils a little bit more than perhaps we do in some of the public markets?
Yeah, I think not all private credit looks alike. So there's a whole slew of funds that traffic in private credit, which is just bespoke lending, and oftentimes in smaller businesses and smaller companies. There are a handful, and it's a much less competitive market for those who are participating in the larger market, and there's a very large market for those that can participate in non-sponsor deals or direct deals. And so I think private credit is not the same. We at HPS tend to tend to do some sponsor stuff, but we do a lot of non-sponsor stuff also. And we tend to veer on the right side of the page, which is sort of larger companies, which I think makes it very different. You asked a specific question with regard to covenants. I think, again, not everything is the same across these businesses. In general, the speed and the certainty of private credit and sometimes the ability to be able to provide capital at the size that might be needed, especially when the capital markets are shut down, do allow for private credit folks that operate on that bigger side to oftentimes get some covenants in place that are pretty valuable.
Is there a downside for the system for private credit? I mean, I just read a piece on the Bloomberg, actually, this week about the Financial Services Board internationally saying we need to know more about what's going on with private credit because we don't know what's under the hood. Is there a risk to the system here that it's opaque in a way that the public is not?
It's opaque in that you can't track it, but this is not a new market. Private credit, banks used to lend to companies, and now there's other people that are lending to companies. So it is opaque in that it's not tracked in the way that the syndicated markets are tracked. And we and others are working on ways to try to figure out how to track that better. I think if you're in a longer rate environment for a long period of time, you will see people that have legacy portfolios that do have some pain. I think in the new era and new deals that are being underwritten, most people are underwriting to a base rate that is in and around where we're sitting today, if not a little bit higher, despite what the curves in the market might suggest. And so I think in those instances, you're not actually going to see as much pain.
Talk about issuance and high yield. When we were together back in July, you were saying the capital markets are almost frozen up.
Yeah.
Are they starting to lose it up now? Are we expecting more issuance in high yield? Because for a while there was very little, as I understand it.
Yeah, there was very little. You're right. In fact, up until sort of halfway through this year, if you think about where we got to where we are this year, we know you've had improvement in CPI, and we know that Fed funds have all but sort of stabilized or gotten to their resting heartbeat. With regard to supply, it's been a negative net supply year in the levered credit markets. And I think as you look forward, as you're starting to see maturities come into play, and we talked about earlier, I don't think companies are going to wait till their last day. And I also believe if you look at July versus today, there is a view that we're likely to stay higher. So I think you're going to see a lot more supply because you have to.
Are you getting compensated for risk in high yield right now? Last time we were together, you were concerned maybe we weren't fully getting compensated. I don't know. I think it's around 430 basis points right now is the spread.
Yeah, which is where it was in July.
Yeah, exactly.
Yeah.
It hasn't moved much.
Yeah, it hasn't moved. And by the way, Fed funds haven't moved, IG spreads haven't moved, levered loan spreads haven't moved, high yield spreads haven't moved. I think you're getting compensated because you're really long the base rate piece of it. And so the yield piece is pretty attractive. Spreads are not. I think spreads are sort of inside of long-term averages. There's a whole bunch of data, which we can get to at another time. But, I think spreads are okay, not super cheap, and likely to go wider because I do think there's more risk to widening than there is probability of tightening.
So as a real novice in this area, obviously the base rates are much higher than they have been in the past. Does that protect you from some risk as a practical matter? Because it's not just the yield, it's not just the spread, it's also the base rate.
It does protect you because you're compounding at 8 to 10%. When base rates were zero, you were compounding at the spread.
So where is the biggest opportunity right now in credit?
I think in credit, there's a lot of different places to play right now. So I think there's a couple things. I think one is I think private credit is pretty compelling. I think the yields are very, very attractive and the structures are attractive. I think two, when you look at kind of the investment grade market and the high yield market and the loan market, investment grade is yielding sort of 6 to 7%. It's fine. It's not terribly cheap on a spread basis, but it's fine. I think there's more risk to a little bit of widening, but you're being compensated. And then in high yield and loans, there's a lot of dispersion, meaning that, if you look at ratings, for example, double Bs are pricing in negative defaults, triple Cs are pricing in high defaults. So I think if you can get these credits picked right and not make mistakes, you're going to earn 9 to 10%, and it's time to start doing that.
Does that give you a lot more work to do to sort the wheat from the chaff, as it were?
It does give us a lot more work to do. We got a lot of people, though.
You have to read a lot of stuff.
Yeah, we do.
Okay.